Hi everyone, we are now going to look at our problems 9.2b and 9.3b for part 1 of chapter 9, which are on accounts receivables and that estimating process that we looked at on the lecture. So hopefully you tried these ahead of time and you're just coming in to see how you did with them. So I'm on page 353. At December 31st, Ingleton Company reports the following results for the year: their cash sales and their credit sales. In addition, its unadjusted trial balance includes the following. So the accounts receivable balance is $575,000 and the allowance for doubtful accounts, remember that contra to accounts receivables, is $7,500. They want us to prepare the adjusting journal entry to record bad debts under each separate assumption. So the first assumption is assume bad debts is estimated by taking 2.5% of credit sales. So we would focus then just on that $1,342,000 times 2.5%. Remember, when you're using sales to estimate, you're really determining the amount of your journal entry. So you debit bad debt expense, $33,550, and credit the allowance for doubtful accounts, the $1,342,000 times 2.5%. Remember also that this journal entry is done whenever we're going to do a financial statement. It is an adjusting journal entry. Under the second scenario, in B, bad debts are estimated to be 1.5% of total sales. So now we're just going to use our total sales amount, still using sales. So we're going to add the credit sales to the cash sales and then multiply that by 1.5% and get $35,505. Again, debiting bad debt expense for that $35,505 and crediting the allowance for doubtful accounts, $35,505. So those are two ways of estimating, both using sales. Now in C, an aging of accounts receivable analysis estimates that 6% of year-end accounts receivables are uncollectible. So now we're switching gears. We're no longer using sales to estimate. We're using accounts receivables. So accounts receivables, $575,000 times 6%. We get $34,500. But what you need to remember is when you use accounts receivables to estimate, you're determining what the new balance should be in the allowance for doubtful accounts. So you need to take into account any prior balance in the allowance for doubtful accounts. Remembering that once you're done with your journal entry, the balance should be on the credit side. So right now we have a credit balance of $7,500. We need it to be at $34,500. So we want to add an additional $27,000. So you're focused on how much do I credit that allowance for doubtful accounts? $27,000, okay? And then I'll do the opposite to bad debt expense, $27,000. So two different estimators. Sales, you're determining the dollar amount to debit bad debt expense. Accounts receivable, you're determining what the new balance has to be at once you're finished with your journal entry in the allowance for doubtful accounts. Now remember how allowance for doubtful accounts impacts accounts receivables on the balance sheet. So we're going to show how accounts receivables and the allowance for doubtful accounts appear on the December 31st balance sheet for Part 1A. Going back, we start with a balance of $7,500 on the credit side in the allowance for doubtful accounts. In 1A, we increase it $33,500 by adding, $33,550 by adding, sorry, I messed up my calculator, that amount of $33,550. So the new balance in the allowance account under 1A is $41,050. So when we show this on our balance sheet under the current assets, we're going to write accounts receivables $575,000 because that's the true balance, less the allowance for doubtful account balance of $41,050. $533,950 is your net accounts receivables. Another way of presenting it on the balance sheet that is acceptable is you say accounts receivables and in parentheses put net of $41,050 allowance for uncollectible accounts and report the $533,950. So either way is acceptable. They also want us to present this given the facts in Part 1C. Well, Part 1C, we determined the balance in the accounts allowance for doubtful accounts. We know it needs to be at at $34,500. That was our estimate. And our journal entry got us to that amount. So we're going to take accounts receivables, again, less the allowance for doubtful accounts, and we will report on our balance sheet $540,500, or the alternative way that you can report. All right, so that is a nice exercise of looking at the different ways to determine the estimate for uncollectible accounts under both scenarios, sales and accounts receivables, and how they're reported on the balance sheet with accounts receivables. We're also going to take a look, I'm pretty sure, problem 3B. Yep, 9.3b. Here, we're going to get a little into the nitty-gritty of estimating. So let's take a look. December 31st, Hovac Company's allowance for doubtful accounts has a debit balance. Remember that. So if you draw a T account, it has a $3,400 debit balance on the allowance account. Remember, the allowance account is a contra accounts receivable account that should have a credit balance in it. It has a debit balance because we didn't estimate enough. Our actual bad accounts that would be debited to that account were more than our estimate. That's why we end up with a debit balance. Further, we are going to estimate uncollectible accounts using accounts receivable, but we're using the aging of accounts receivables. Wow, so let's take a look. So the first part of our calculation is determining how much of each age group don't we expect to collect. So we take each total of each age group by the required percentage. So 396,400 times 2%. 277,800 times 4%. That's what this company decided they would not be able to collect of each age group. Look at that, over 90 days past due. 82% they don't expect to collect. Okay, once you determine the dollar amount for each age group, add them all up, and then you get an overall total. So of the amount in accounts receivables, the company does not expect to collect $27,990 of it. So they just determine what the new balance needs to be in the allowance for doubtful accounts. Further, remember, that balance must be on the credit side. Currently, we have a debit balance. The only way to get that balance to a $27,990 credit is to credit it for $31,390. So we have to make enough of a credit in there to get it to that estimate of $27,990. So $31,390 on the credit side, $3,400 on the debit side will give us that balance. So debit bad debt expense for $31,390 and credit the allowance for doubtful accounts. And if you sit and think about it, remember, last year we didn't estimate enough. So we're taking that incorrect estimating of $3,400 and just putting it in this year. And that's okay, you can do that. That's what essentially we're doing. Now, on July 31st of the following year, Hovac concludes that a customer's $3,455 receivable is uncollectible and the account is written off. Does this directly affect net income? And the answer is no. Remember, what's our journal entry then on 7/31? There we go. We're going to debit the allowance for doubtful accounts, $3,455. Oh, shoot, I didn't mean to do that. It's just because it's the formatting here, and I apologize. Oh, man, this is not going to work. Let me go to a different sheet. Let me go to a new, there we go. So the journal entry on the next year, 7/31, would be a debit to the allowance for doubtful accounts. Because remember, whenever we have an actual bad account, we debit the allowance account, and we will credit accounts receivable. So these are both asset accounts. One's a contra and one is just an asset. So there's no impact on any income statement accounts. So there's no impact on net income. Okay, so I'm going to go back over to my original. So again, that explains that in there. The only time our accounts receivables really will impact net income is when we're estimating for bad debt expense. Remember, that's the only time we're doing anything to the bad debt expense account itself. Okay, so those were the problems we were going to look at for this part 1 of chapter 9. So please make sure you post any kind of questions you may have to the discussion board.